Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, really any kind of real estate investor, whether you're active or passive, trying to learn about investing in apartments, or you are already doing it, maybe you are working in the industry or already investor, well, the Gray Report is the show for you, whether you're listening to it on podcast or watching over on YouTube. Every single week, we're breaking down all the latest news, research, and data that is essential for you to make the right and most informed investment decisions. The last couple of weeks have been incredible in terms of rate movements, and I believe it's really changed the market, and I want to get into that more specifically today. Unfortunately, Matt Bosnagel, who usually joins us every week, he's out on vacation right now, so I'm going to be doing the whole thing by myself. So we're going to have a good time. Let's get into these reports. All right, everyone, welcome back to the Gray Report. If you're not subscribed to the Gray Report, make sure you hop on over to the Gray Capital YouTube channel, or you are subscribing on wherever you get your podcasts. But if you'd like to receive the Gray Report newsletter, really packed full of, literally dozens of all the latest research reports every single week related to multifamily, real estate, and the economy, pop on over to graycapitalllc.com/newsletter to sign up for the free newsletter. We believe it's the best multifamily newsletter in the industry. All right, we've got some really interesting reports. But just before I get into it, I did want to just talk about how the market has changed in the last 2 weeks. We are not in the same market in terms of real estate that we were a couple weeks ago. We've been in a declining rate environment really since the start of the pandemic, and we're no longer in that environment, and we're seeing the fastest pace of rate increases that we have seen for years. The last time the Federal Reserve was raising interest rates back in 2018, it was relatively gradual. And while they're forecasting that the rate increases we're going to see now will also be gradual, the dot plots that the Federal Reserve has put out shows that we are going to be going much higher. And that's going to be a completely fundamental change because of how low the cap rates are in the multifamily market. And we talked a little bit about this last week. We're already seeing inversions of people buying at cap rates that are lower than what their interest rates are. Because you could have easily underwritten a 3% interest rate a couple months ago, but now your interest rate is looking to be in the mid 4s all the way up to 5%, lower leverage. And in my opinion, the amount of risk for some floating rate loans has grown exponentially compared to the risk premium that you would achieve. And as a relatively conservative investor, when it comes to real estate and looking for the right balance of risk and reward and trying to accurately judge how much premium are we receiving on taking the risk, well, you can have to take a lot of risk right now to be able to really stretch the returns that you may want to hit. And taking a little bit lower return on a lower leverage fixed interest rate, while on paper may not seem as attractive, when you factor in the amount of risk, it actually looks really, really attractive right now. And that's because the fundamentals in the housing market are still so strong. And if anything, they are still going to be steering more individuals into apartments rather than buying a home. So that's one thing I wanted to talk about. We're actually changing a lot of the way we're looking at deals at Gray Capital right now because of this environment. Not every operator, investor, or syndicator has kind of gotten up the speed where we are. Some certainly have, but not everyone. I think it's just a time to be cautious and not just do deals the same way that we've been doing them over the last 2 years because, again, we were in a declining interest rate environment versus a rising interest rate environment. In one tenet of investing that I believe in is we want to understand what the Federal Reserve is doing. Understanding their playbook is critical. And the last thing we want to do is to fight the Fed, go against that grain and really receive a headwind to our investment strategy, rather finding the way to go with the Fed and use that momentum as a tailwind. And that tailwind is inflation, rising rents, but you don't want to get smacked with the headwind of rising interest rates. So it's imperative to find the right ways to mitigate that risk. And that's what we're doing here at Gray Capital. You can go over to graycapitalllc.com to learn more about how we're doing that. the types of properties we're looking at, how we're mitigating risk. And you can just go to Gray.fund if you're an accredited investor and want to learn more about the fund over at Gray Capital. This isn't an offer to invest, but just if you're interested, go check it out. All right, reports on the Gray Report this week. We've got a great one from CNBC, Globe Street, BizNow, Inman, Commercial Real Estate, Commercial Research, and Forbes. And we're going to start just a little bit macro because, and this is something we've talked about on the report in the past, but the yield curve between the 10-year Treasury and the 2-year Treasury inverted yesterday. So why is that important in terms of multifamily investing? Well, the biggest source of capital in a multifamily project, and most projects that use some sort of debt, which most do, is the debt. And if your cost to borrow, that cost of capital increases, that severely affects how you're going to function. And knowing that the rates are continuing to increase, it changes your strategy and how you'd finance that deal. But even more, maybe more importantly, is understanding the correlation of the yield curve to investors in a macro sense as a predictor of a future recession. And I think that now it is certainly possible that we will see a recession in the next 18 to 24 months, given that the Federal Reserve may take extreme measures to curb inflation. We've seen it in the past. They will create a recession, on purpose or not, to bring inflation in check. And so we just need to watch out for that. And again, the housing fundamentals are so strong, it's the right asset class to be in because multifamily is a hedge and very recession resilient, but you have to structure it in a way with a high degree of margin to safety. So that's why we're looking at lower leveraged, fixed interest rate, and longer term holds because we don't know in this recession. There may not be a recession. Maybe it's in 4 years. We want to be able to hold kind of through that and be able to control the time of exit or refinance. So let's look at these yield curves again. So we're taking the longer term U.S. Treasury bills, the 10-year, and then we're going to deduct the current yield on either the 2-year Treasury, but we're also looking at the 3-month Treasury, which is much closer tied to the Fed funds rate that the Federal Reserve actually has some control over. Most multifamily loans that have a floating interest rate, they are based on the Secured Overnight Financing Rate, or SOFR. Longer term fixed rate loans are typically based on the 10-year Treasury, which has seen the most movement. The 10-year Treasury is much more influenced by market sentiment and many more things can be priced in. And we've seen quite a bit of divergence between the 10-year Treasury and the 3-month Treasury because the 3-month Treasury has only gone up a little bit because the Federal Reserve, while they have increased rates up to 25 basis points on their Fed funds rate, that's still not that much. I mean, it's only 25 basis points, 0.25%, and forecasts have that rising all the way to 2%. So what we're looking at here is a chart of yield curves. We have the 10-year minus the 2-year and the 10-year minus the 3-year. You'll see, I'm going to zoom in a little bit, just the divergence between the two yield curves. We have the 10-year, we have the 10 minus 2. It went negative yesterday. You would be paid more interest to borrow on a 2-year Treasury than it would pay to borrow on a 10-year Treasury. Essentially, that means people do not have a very positive outlook for the future, or at least the bond market. And the bond market is known to be the smart money, although I think that's debatable. But see how different it is compared to the 3-month Treasury. It has moved so much just because, again, that 2-year is a little bit closer out to the 10-year. And that is just incredible, that divergence. We actually have to go back to the mid-90s to see a divergence that was similar, really kind of going back here to, 1994, where we saw such a gap between the 10 minus 2s and the 10 minus 3s. But the reason why everyone watches this metric is the correlation of recessions. Once the yield curve inverts, every single time there's been a recession 18 to 24 months later. We see it happen in the early 80s. We see it happened in the yield curve inverted in 1989, and we had a recession just at the end of 1990. The yield curve inverted again back here in June of 2000. all the way through 2001, and we had a recession in 2001. 2008, well, the yield curve first inverted back here in 2006, and we had a recession in 2008. So that was about a two-year time period. And then even more recently, the yield curve inverted at least first the 10s minus 3s and then the 10 minus 2s. It converted back in 2019. And you may say, well, how would the bond market predict the pandemic? Well, many people were saying there was going to be a recession either way, not knowing about the pandemic. But regardless, there was a recession that happened in 2020. And so far, when the yield curve inverts, it is a pretty good, consistent indicator that there is could be some trouble ahead. But then what do we do with that information? I think that's the biggest question, because in a high inflationary environment, going all cash, you're losing 7%, up to 10% this year, just being devalued by the dollar. So you need to go to a safe asset class. The stock market can perform, well after the yield curve inverts until a recession. Ton of volatility, no tax benefits, and most people are over allocated to the stock market anyway. That's where multifamily still offers a very attractive risk-return profile. But as we were talking about previously, you have to do it the right way, and you got to partner with a group or do it in a way, bring on the right knowledge, so you are navigating this crisis appropriately, and you're not taking unnecessary risks. Because again, if you structure a deal like everyone was structuring deals, including us 6 months ago, you could be setting yourself up for trouble. So let's look just a little bit more macro, moving away from the yield curve and talking about recessions. Because the reality is the economy is doing great right now. Companies added, this is according to ADP's private survey. So this is private payrolls. I believe the BLS will release the government's numbers here shortly. I think usually they do it on Friday after this report comes out. But huge increase. Payrolls grew by 455,000 in March, slightly more than anticipated, with leisure and hospitality leading the way, adding 161 positions. So we're seeing really strong job growth. Government's going to come out. It's expected to grow at 490,000 when the government puts out their report. This is all leading to this conversation of a wage price spiral. People are picking up, getting back to work. All this pent-up demand from the pandemic is being released and is all going to be added drivers of inflation, which again is why I personally believe that the Federal Reserve is going to be forced to take measures to raise interest rates quickly, and we need to take measures to protect ourselves from that eventually occurring. And if it doesn't occur, that's great. We're still setting ourselves up in the right way. So it'll be interesting to see when the government's report comes out, but we are seeing really strong job growth. And in general, if you look at most indicators for the economy is in a great place. The reason why they have to raise rates is because the economy is doing so well. But as we've seen going back to 2006 and other times when things are going really well, it can switch on a dime, and we have to be careful of overheating, again, in a tightening environment, because the Federal Reserve, they know how to kind of mess things up. They can't predict the future that well, and they have a major influence over not just the U.S. economy, but the global economy in general. So just one thing we absolutely need to watch out for. All right, now let's take a look at a Globe Street piece. Really, this is it's an article from Globe Street, but it is quoting Zumper's March report on rent growth. Surprise, surprise to Gray Report listeners. It's incredible, though. Multifamily rent growth this year is outpacing 2021. 2021 was the highest year of rent growth, I believe, ever on record. In 2021, we are already set to outpace that number. Now, that seems absolutely insane for a lot of reasons, just because it's hard to believe that prices are still increasing. But what I find is important, besides a dose of, again, just caution, because it's just an incredible volatile period that we're in right now, is looking at rent growth in relation to other components of CPI in the economy, and because we're all looking at this it's all inflation. It's all about the value of the dollar decreasing, and what are rents relative to the value of the dollar and other assets. When we look at other assets, other components of CPI, rent has actually grown the least compared to, whether it's commodities, gasoline, all the other components that make up CPI. Shelter and rent, it certainly has grown, but when you look at food costs going up significantly, I mean, wheat's up, however much, 50%, fertilizer, all of these inputs our costs are going up and up and up. And so in a world where everything has increased by 50% or 60% over a couple of years, or many items, why I guess the question is, why is it so hard to believe that rent isn't growing somewhat as well? Now, it's certainly been outpacing inflation, but it's more of a counter argument to the idea that rents can't go up anymore. Because I would say you could make that argument about all the other prices that are going up. Then factor in the extreme supply-demand imbalance where we just haven't built enough housing over the last 10 years. It's hard to imagine. It would make sense that rents would continue to rise. So just absolutely incredible that we're seeing continued rent growth. And we're just getting into peak leasing season. Multifamily is seasonal. Rent growth is seasonal. And March is when we start to see it start to rise, and it really peaks in July. So we're going to see March, April, May, June, and July. We anticipate to see very strong rent growth. But there's a big reason for that is new construction. The cost of materials has gone up so much. So any new deliveries, they're charging the highest rents that they've ever charged. That allows properties below that to try to at least match that or kind of bump up a little bit more. At the same time, you have a lot of property managers and owners that weren't as tied. They weren't subscribed to the Great Report, obviously. They weren't as tied into where the market actually was, and they were making the same type of rent increases that they make on any given year, maybe 3% or so. Again, maybe a nominal amount, $10, $15, $25. But the market moved $50 or $100. And they've realized that now. They finally subscribed to the Great Report, and they realize they missed out on an entire year of increased NOI. So they're going to be catching up, and we're going to continue to see those rent increases throughout the market itself. All right, so let's look at an article from BizNow this is about specifically Philadelphia, but I think it's a good example. And we have kind of a counter piece to this as well. The extreme shortage of for-sale housing in Philly's suburbs is a security blanket for multifamily. This is essentially saying, even if you can buy a home, you want to buy a home, there just aren't the homes available for individuals to purchase. We're seeing a lot at Class A properties, luxury assets have higher rents. They are filled up with people who are making significantly high incomes. They either want to buy a house, they're building a house, they're renovating a house. This is increasing occupancy at properties, but a lot of these individuals, they're going to give up because they're trying to buy a home. They're making offers, they're putting in $100K over asking. They're getting beat out by someone who put in $250K over asking, which is absolutely incredible, but it's the market that we're in. I would maybe not a counter argument to this, but Inman talking about mortgages, rising mortgage rates not deterring spring home buyers. Now, the interest rate they're going to be paying on a 30-year fixed mortgage right now is just under 5%. That's basically double what people were paying during the pandemic, and you would think that would start cooling things off. But again, if someone's willing to pay up $250,000 more, $100K on a house, they probably can afford paying a little bit more interest. Not that makes sense. Also, single-family home buyers, they're not always as sophisticated. They're not looking at it as they should not as an investment. They want to buy a house. If they can afford it, they apparently don't care what the price is as long as they can somehow qualify or get a cosigner to help them qualify, which I think is a lot of what is going on. I would also like to note, though, that we're early on. Again, the Fed has only increased rates once, 25 basis points. Now, these mortgages are based on the 10-year. As we were looking at the Fed funds rate, where they're raising rates in the shorter end of the yield curve, or the maturity curve. The mortgage rates are typically backed or based on the 10-year, which is more market driven, and that has priced in these rate increases. So I don't know if we're going to see the 10-year rise too much more. We're going to see the shorter maturity loans or bonds continuing to increase. But it doesn't mean that the 10-year is not going to continue to go up. I think it could easily get to 3%. And so there will be a point, we're not there now, but there will be a point where high prices will be the cure for high prices, and those high prices are going to be the cost to borrow and the interest rate on those mortgages. So we just need to watch out for when that occurs. Because right now we've seen the huge shift in terms of the equation of whether it is more affordable to rent or to buy. The last 10 years is actually a better deal to buy because the housing costs and where rents were relative for what you could buy a house for, that's completely switched. Single-family homes are so expensive. It's now a no-brainer to rent. And again, that's going to continue to drive renters into apartments. Maybe they would like to rent a single-family home, but they're not building enough build-to-rent communities quick enough. Another driver of not only multifamily, but the economy in general is all the industrial development that is going on, mostly because this provides jobs in a handful of ways. Now, this is also a driver of inflation. As you're building more, you're having to pay high wages to build these types of facilities. That all is kind of a benefactor, or multifamily is a benefactor of all of that. And we see there's 593 million square feet that is in the pipeline at the end of February. And there's a lot of it industrial. And almost all of this is being driven primarily by the shifts in the supply chain, the growth of e-commerce, and companies doing more manufacturing onshore. The supply chains were obviously completely disrupted during the pandemic, and all of these companies, the Amazons, the Walmarts, and everyone else had to rethink, how do we do these supply chains? We need more last mile delivery. We need a more decentralized system, and that has just increased the demand for industrial warehouse and logistics properties significantly. So why we're talking about that related to multifamily, it's commercial real estate. We like to talk about that. But again, think about all the jobs, the people who are going to be working in these facilities, the people that are going to be needed to construct these buildings. It's a lot of jobs. And they're often in areas, and you've heard us talk about this, but there are sometimes in areas where there's not a lot of housing. We have a property under LOI right now that there's no new apartments in the pipeline. There's hardly any apartments in the area. But there's millions of square feet of industrial logistics and warehouse being built, all paying, good paying jobs. Where are those people going to live? We already have a housing shortage. We just have a mismatch of the right housing in the right place. So we see that as a big opportunity. It's one of the themes of the Gray Fund, finding opportunities near these logistics centers. Again, good paying jobs are just undersupplied in terms of housing. And again, not an offer to invest, but you can check out Gray.fund if you'd like to learn more information about kind of the way we're looking at it. All right, last piece on the Gray Report for this week's episode. I wanted to talk a little bit about kind of ESG in terms of investing in apartments and real estate itself. And Forbes has an article, Jeffrey Steele wrote this, and this is particularly about greenwashing in Toronto. And so we're not really going to get into kind of the meat of this article, but more I thought it was a good prompt to discuss. This is something that I've just seen and I've thought about, and sometimes it bugs me. Some groups are doing this the right way. Some groups I don't think are. So ESG, environmental, governance, and sustainability. It's essentially investing either with some sort of social impact and social goal, whether that's the environment or for social issues or governance issues, or think about investing in a company that's building solar panels or trying to make the world better, but it's for profit. And this whole idea of greenwashing, of basically you're just getting a little stamp of saying, hey, we're doing the right thing, we're conscious of the environment or the community, whatever it is, you should invest in us because of that. And at the end of the day, you got to have a good investment, but basically these ESG stickers it's like, well, You can make a investment in something, and the returns and the profitability, maybe they don't matter as much because there's a social impact here that's harder to quantify. And you're making an investment in society, not just whatever this investment is. In theory, that's great. And again, I think there are some groups that do have a specific mission and are accomplishing that mission, and we should support those groups. I found often that when you do the right thing, whether that's for society or culturally or environmentally, often you end up seeing some upside from that as well. Not always, it's hard to underwrite, but we try to think that we always try to do for our communities and doing the right for residents, for example, and treating them as is just people and in our neighbors. There's a value add in that itself, is because you could create a sense of community. Now, on the other side, though, there's groups that who are saying that they are doing something nobler than I think that they really are. And they're basically saying because they're investing in properties that are low income, they are somehow ESG because they're not being as aggressive, or they're supporting, housing in general, which is great. That is what we're doing. That's what, like, at Great Capital we like to do as well. We see this housing shortage, and we need to improve and fix up and maintain the housing stock. I mean, there is, of course, what we believe what we're doing has great benefit to society. But I think it's a next step to, put a sticker and talk about how you're saving the world when you're just trying to put a real estate deal together. The goal is to make money, and let's talk about the profitability of the investment just on those terms. If you want to say you're doing a good job helping people out and creating a better society, well, certainly I would hope so. I would hope that the business objectives were not to be damaging society. Some may be. Shouldn't invest in that. To have a little sticker of ESG, I think is, again, some folks are taking extraordinary steps, and I applaud them, and I think that is incredible. We like to take extra steps as well, but I'm not going to just put a label on us as ESG just to be able to raise some more money. So a little bit of a rant, but I think it's something important to watch for when someone is really touting you should invest in this because of ESG. To me, that would be a red flag. Doesn't necessarily mean there's anything wrong. Maybe an absolutely outstanding operation, but I would watch out. If you like this episode of The Gray Report, or just The Gray Report in general, make sure you're subscribed to not only the YouTube channel, it's the Gray Capital LLC YouTube channel. You're also downloading the podcast, and you can listen in the car, stay up to date. The real way to get all this information, though, is graycapitalllc.com/newsletter. It'll let you sign up for our weekly newsletter. It's going to give you all the articles, all this data, all this research reports. You're going to be talking to your real estate buddies. You are going to be on top of it. Be able to make the most informed decisions and back up what you're talking about with some actual useful data. That it takes a lot of time to put all this stuff together, and props to our entire team that works on it throughout the week to do it, to bring it to you. Give this video a like. Again, make sure you subscribe. Leave a comment. If there's ever any topic you want us to touch on, just leave it in the comments, and we will be sure to get into it on the next episode or as soon as we possibly can. My name is Spencer Gray. Again, I'm the president of Gray Capital. I appreciate you watching this video. Thanks for taking the time. Hope you have a great rest of your week, and see you on the next episode of The Gray Report.